Welcome, everybody, to the Alternative Investing Club. If you are there, can you put your a comment inside the comments on the side? Let us know where you're coming from. Oh, I see 8 people here. Okay, looks like we got some 9. Looks like we might have some learning curve. People are joining, I think. We usually kick off at around 5 minutes after and let people join for the first 5 minutes. So, might be that. Hey, if you're there, could you just say hi? This is our first time on this platform, and I'd love to see a hi in the comments. William McZeep, Prolet, great to see you guys here. Austin, Texas, California. William, are you in Folsom, California? Robert's here. All right, we're going to wait for hello, Manju. Hello, Maya. We're going to wait for a few minutes just to let people figure out how to join. Since we're on a new platform, I expect that there'll be plenty of stragglers today.
Good. First one of the year.
Yeah. First speaker event of the year, and we've got a great lineup actually for this month and for February as well. I'm really excited about the guests we have coming in. We have Equity Multiple. They're coming in. They're going to be speaking to us twice here about their business. We have the founder of CrowdStreet coming in this month. We have Rebecca Taylor, who's in rehabbing, coming in next month. We have an interesting fund that I am very bullish on that has that makes its money from accounts receivable contracts. So it's definitely a non-correlated asset, and it looks to be very promising. And they will probably be a club fund speaker introduced in February. And of course, next week we have still a little bit of discussion on who's coming in, but I have 2 potential candidates there. One who is developing a Ritz-Carlton in the Caribbean, and the other one who is creating manufactured homes in Texas. And we need to work out the scheduling for next week. But both of them will be here, and both of them will be great talks. So we're going to wait a few more minutes as people join. I'm going to check my email. If you just joined, can you drop a hello inside the chat to make sure that we can see it? Keep in mind, too, you can also join this from Facebook, from LinkedIn, from YouTube, and from X. We're streaming live to all of those platforms today. And you can use the chat in all of those platforms. I think maybe with the exception of YouTube. They disabled comments in one of my videos, and I'm not sure why. So drop us a line in the comments. Tell us where you're from. Hello. All right. While we're at that, I would love for everybody here to go over to LinkedIn. I just started a Alternative Investing Club page there, and I can't stream live to that page until I get 150 people on it. Right now we're at 75, it looks like. So I'm dropping the link in the chat. If you would, could you go over there and follow the page? And as soon as we get to 150, we'll have an official location on LinkedIn rather than just my personal account. Let's see. The other thing I wanted to test is it possible for people in the meeting to unmute themselves? I don't know that it is here, which means I'll be relying on the chat. And I'll definitely want to figure out if that's possible or not, because I love getting live questions as well. Oh, and of course, the other thing, I got some mixed signals about whether Alternative Investing Club .com/live was accessible inside the Intel network. Thank you, Ryan. Yeah, I think that since this is set up as a webinar, there's not a way to unmute. I might be able to figure out a way to get around that. We'll see. If you were able to reach alternativeinvestingclub.com/live from inside the Intel network, could you please mention that inside the chat? I want to make sure that people there can see it. I got some people that could. I got one person who said there was a DNS error. I got another person who said it was flagged as malicious. I just want to know that people can actually reach it from inside Intel. And also, if you had to resort to using the StreamYard link, please let me know that in the chat too. And so we're kicking it off here. All right. Sue Park says she got a DNS error. Rob Gill says he was able to get to it from inside Intel. Dave Bonner says he can get to it from within Intel. So I definitely have a mix of people who can and can't access it from inside Intel. All right. That might be because if you're viewing this on the Alternative Investing Club page, it's an iframe. And so we're loading up, StreamYard's streaming platform through an iframe on the web page. That potentially could be flagged as a security problem in some configurations. But maybe after multiple attempts, it worked for me after multiple attempts. Well, that's even more suspicious. Well, I'm glad you're all here. And of course, I guess I'm not hearing from the people who couldn't get through.
Survivorship bias, right?
Yep. All right, we're going to kick this off. We're 6 minutes after. Welcome to 2025. I am so grateful that you're all here. We have a great lineup of speakers that are going to be in. Next week, we have a person who's coming in to speak to us about developing a Ritz-Carlton in the Caribbean. After that, we have the founder of CrowdStreet. We have Equity Multiple coming in for another presentation. And we have a new asset strategy or a new investment strategy coming in, helping people with debt consolidation and creating a fund based on accounts receivable and debt collection. I'm really excited about this. The fund actually specifically helps firefighters and first responders and veterans. And so they target first responders and veterans who have health difficulties, and they buy their debt, they negotiate it down, they give them a lower interest rate that allows them to climb out of the debt that they're in. And they purchase that debt with investor capital. And it's quite a profitable, at least on paper, venture. So we're going to hear from them starting in February. All right, Daniel, can you share your screen?
Sure.
Oh,
yeah.
Let me introduce Daniel here. Daniel is from Equity Multiple. I think a lot of people you here know Equity Multiple. They're local to the Portland area. And if you've been around the passive investment area, they've been a big player there for a number of years. Equity Multiple has been on my radar for probably 5 years or more. So I'm glad to finally have somebody from Equity Multiple here. Daniel, welcome to the Alternative Investing Club.
Well, thanks for having me back, Daniel. It's a great name, and we just had a podcast a couple of weeks ago, I think, as well. So it's really great to continue on the conversation. And Happy New Year to everyone. Glad to see that we've got everyone across the country, and you got a lot of people out there. So that's great. I'm going to be going over a quick presentation today, just about a topic that I think is pretty relevant to self-directed investors, especially when we talk about alternative investing, and a lot of those asset classes that Daniel just talked about sound very, very interesting. Equity Multiple, we are a real estate company. We have just real estate investments. I'll go ahead and share my screen really fast, and we can just let me get this downloaded. I just want to make sure that the slides are in the right place here. I'll be going over real estate, and a lot of people, I think about real estate, and they have an idea of what that is, and they have an idea of what they're looking for. But I'm going to be going over a set of types of real estate investments that are beyond just your typical type of investments. Now I've just got to upload the file here, and I'll be able to share my screen. Everyone's got a learning curve today, right?
Yeah.
All
there
right.
it is. I see it appearing here. It looks like I probably need to add it to the stage.
And there we go.
There we go. Perfect.
Great. All right. So looking beyond the core four, I was alluding to this. We're trying to expand the CRE portfolio. So beyond just beyond just expanding the asset classes, even within different types of asset classes, even within private credit, you can get access to a lot of different types of private credit. Within real estate too, you can get a lot of different types of property types that you can diversify. I'm the director of investor relations for Equity Multiple. We're a platform providing investors with access to institutional commercial real estate opportunities. Just a quick background before we get into the meat of the slides. We were founded about 9 years ago, almost 10 years ago now. Charles Clinton and Marius Schulson. They were really trying to bring access for investors to large real estate transactions that you might not have had access before. Instead of having to put up millions of dollars for a real estate transaction, being able to put up tens of thousands of dollars instead. So really being able to tailor your portfolio and get access to a lot of different types of real estate. Marius is the CIO and one of our co-founders. He's got a lot of connections in the real estate industry. And Charles himself, our CEO, was a private funds lawyer working on large transactions for Blackstone, KKR, and the like. I'll just jump right in to the meat of the presentation here and talk about CRE and the Core Four. And I'm not sure if you've heard of the Core Four before. I might have talked about I've talked about the core asset classes before as well. But when we talk about the Core Four and commercial real estate, we're talking about those core asset classes. But maybe we back up and just talk about specifically what CRE is. Drop in the chat if you've invested in commercial real estate before. Maybe you've done a single family home or a fix and flip or something like that. Just wanted to get a sense of how many people have invested in commercial real estate before. And commercial real estate, beyond just a single family home that you might invest with a friend or a colleague, or a quadplex or a duplex that you buy and rent out. There's a lot of different types of real estate. And commercial real estate is anything that's multifamily above a duplex and above. A lot of people see retail and office space, industrial, but there's a lot of different types of commercial real estate out there. And even beyond just the different property types in commercial real estate, you've got private credit, you've got private equity as well. And there's different types of return streams that you can get with commercial real estate. Beyond just buying a single family residence and renting it out, you can get a lot of different types of investments there. One of the biggest advantages of investing in real estate too, obviously, is you get that real return tied to the economy. So as rents increase, as inflation increases, your rents can increase, and a tangible asset like real estate can really outlast a lot of other types of assets that might not be tied to real economic drivers. Now, when we talk about the Core Four, these are the largest property types in CRE. Multifamily, office, retail, and industrial. Those make up the bulk of transactions. And as of 2023, that was $62 billion of transactions. The largest by far is going to be multifamily, followed pretty quickly by industrial. Office was one of the largest transactions for most of commercial real estate. And a lot of people still associate commercial real estate, that word commercial, with office and retail. But commercial real estate is really just buying a real estate for a commercial venture. So renting out to other people. Multifamily or apartment is the most familiar asset class. A lot of you might have invested or seen multifamily offerings from other syndications. And really, they're the Core Four because they're core to the economy. You have a lot of transactions that go on. Everyone lives someplace. Everyone used to work in an office. You still have to go to a lot of retail and strip centers for grocery stores. And industrial properties are really crucial and key to the economy, especially with the rise of e-commerce and ramped up distribution and manufacturing centers. So these are still a lot of the core holdings. One of the benefits is, of the Core Four investing in these types of properties is that they're the largest. They're potentially very liquid in the market. You always tend to be able to find a buyer for some of these properties. And like I said before, they're key to the economy. Everyone needs a place to live. Everyone typically needs a place to go buy groceries and go to the gym. And large institutions still need to buy warehouse space to store their goods and manufacture a lot of things. And they're really well understood asset classes. You can understand in the same way that you can understand blue chip stocks. You can understand how multifamily should be priced. You can understand how industrial should be priced. So there's always that strong institutional demand, and it gives you that liquidity. But they tend to fall short. And in the same way that they're large and liquid, there tend to be crowded markets. There's a lot of different syndicators for multifamily. There's a lot of different core plus funds for industrial and single tenant industrial. And although they're core to the economy, more rigid and well-defined property types might not be as adaptable to the economy. What we're seeing a lot of times with office right now is that a lot of the space cannot be repurposed because it is so, so rigid, so fixed in its allocation. And because of the crowding and because of it's so well understood by the rest of the market, you tend to get less sponsor or management edge or the alpha that you can create. So you're going to get really good returns based on the economy or based on the asset class. And real estate tends to be a core holding for a lot of institutions, but you're not going to be able to necessarily get outsized returns for some of these more core asset classes. So how do we add more to this, to your portfolio beyond just the core four? If you have those as your core holdings, and I think that they are still a big core option, what else can you add to potentially get alpha? Well, beyond the core four, as I've been speaking about, you've got a lot of other different types of asset classes. At Equity Multiple, we've invested in every single one of these: campgrounds, hotels, medical office buildings, self-storage, car washes, student housing, which is, I guess, a subtype of apartments. And you get access to these niche and emerging asset classes. And as the economy evolves, each one of these can potentially become much more attractive. For example, because of the Tax Cuts and Jobs Act, you saw a lot more bonus depreciation allocated towards environmental waste disposal. And environmental waste disposal is a large part of the car wash business. Anything that has water, anything that has water recycling is going to be classified as a environmental waste disposal. So what you get here there is that car washes became very, very popular in the post-tax cuts and jobs cut era, and we saw a lot of excellent returns and very attractive opportunities from car washes. If you had only stayed in the core four, you would not have necessarily had access or been looking at car washes. Similarly, with self-storage, it's a very popular asset class as the economy evolves. As more people have been moving around, have been downsizing their homes or looking to change, you see a lot of self-storage properties become very popular. And the trade-off between campgrounds and hotels is also very interesting. Hotels in the pandemic era were obviously not very lucrative, but what did become very attractive was the campgrounds. People were not staying at hotels, but they were still wanting to get out on vacation and going to campgrounds. So we saw a lot of different opportunities rise and fall as the economy's changed, and having the nimbleness to go to different types of property types has been very, very compelling for us as a company. And beyond just these niche types of assets, and I alluded to it with the student housing, is you've got subtypes of each of those core four property types that can also add a lot of value. Within apartments, you've got condo conversions, you've got luxury condos that you can sell out, fractured condo sales. Within industrial, even there's myriad different types of industrial buildings that can benefit from strong local sponsorship and a bit more nuanced underwriting to really understand the value proposition. So I think even with the core four, even with a core real estate holding, investing in a core and satellite method, core being your core real estate holding, satellite being adding small asset classes on top of it to take advantage of changes in the economy, can be a pretty compelling opportunity when you're adding to your alternative investment sleeve. So I had some advantages and disadvantages for the core four, and I think the complement of the core four to the alternative investments, alternative property types is, there's less competition from institutional managers. Not every large player is going after car washes, is going after distribution centers. They're not looking at these smaller niche asset classes in the same scaled way as you might be looking at multifamily or other institutionally managed commercial real estate. I mentioned local sponsors, right? With student housing, that's a very local type of investment. With cold storage, the refrigeration centers, though, it's a very fractured industry. So you need to benefit from strong local sponsorship, and that local sponsorship can extract potentially more alpha. Alpha being outsized return for the amount of risk that you're taking. It also, as I said, in a core and satellite approach, can provide a lot more diversification. If you're just investing in multifamily or just investing in office, you can see what happens when large macro shifts in the economy affect one specific property type. Diversification is one of the only things that we can do to really add value to our portfolios without active management. So diversifying, I think, is very important. And they also have strong economic cycle resistance. For example, with self-storage, you see a lot of positives in both up economies. People are moving, they're turning over their space. And on the downside, when they're downsizing their apartments or changing their houses, they need a place to store their extra stuff. And as new asset classes become available, you want to be able to take advantage of that. And partnering with a manager that can take advantage of those new asset classes, that has a pulse on the market and is underwriting those with the expertise, I think is important. Car washes, as a strong example, a few years ago really came on the scene. But before that, I don't know that everyone was looking at car washes as such a strong investment. Mobile home parks in the same way, and modular housing is something that's really become more attractive. And from speaking with investors, and even though they're such large deals, distribution or data centers and other things that are affected by the AI boom are new asset classes that many people might not have understood 10 or 15 years ago. I remember when I was working at UBS, we had an entire fund that was dedicated to cell towers. And American Tower is a REIT that's on the market that specializes just in cell towers. And again, 15 years ago, not many people were thinking about where can I place a cell tower, but that's a piece of real estate that's now, crucial. Everything that we're doing is being bounced off of cell towers right now. So adapting beyond just the largest asset classes, I think is very, very important. And I think it's analogous to, you have a core holding of S&P 500 stocks in your large cap portfolio, but you might take tactical bets into some smaller markets or to some smaller stocks to really take advantage of shifts in the economy. Now, I mentioned the nimbleness of the sponsors as well. And, I think there's some overlap between property type and the market size as well. So the large players on the top there, Blackstone, KKR, Starwood, the guys with the largest REITs, and Blackstone dwarfs everyone. They should be probably 10 times the size they are on this slide. They like to invest in what's known as the institutional market, those $50 million plus transaction sizes. And that's great. They get access to the biggest deals, they get access to the best terms, but they're limited to the types of transactions they can do. And really, when you step down to that middle market is where you can get a lot more interesting and bespoke transactions. They're smaller transactions, they're more tailored investments, and they're much more local. So instead of investing just in massive deals in New York or massive deals in Los Angeles or Texas, we can look at deals in Chicago. We can look at deals in Tampa or in Jacksonville, and it's much smaller metros. And investing outside of those markets allows you to work with local sponsors who really know the market. And these ignored transactions, or these deals which have been ignored by the bigger players or have been only managed by a mom and pop shop, you can pick up that investment and really extract a lot of value from it. And even though they're the middle market, even though they're smaller deals, they're still larger than an individual deal size. You're not buying a duplex for $2 million and fixing up both units and living in one. These are still large enough to be professionally managed, but they are small enough to provide a lot of nimbleness. We can close deals, as an example at Equity to Multiple, in just a few weeks, whereas some larger transactions might take months to close. So I think there's some trade-off, again, between investing in much larger deals, which might be more understandable or which might seem more stable, versus trying to do it yourself and doing a lot of the work yourself. So there you have it. I think combined with the core four, investing outside of those core assets, getting more diversification, getting into niche assets and unique opportunity, combined with working in the middle market, taking highly local, low competition deals where you can really do the work and the research to understand those deals, providing nimble access to good sponsors, combined gives you a lot of alpha. Taking advantage of those deals, taking advantage of non-competitive markets, doing the research to see it first, and it combines to, I think, provide a lot of alpha to the portfolio. With that being said, I'd like to take some questions if we have some. I know I speak very quickly and try to be quite terse, but I'd be interested if anyone's got any questions. You can write it in, or not sure if we can speak it in either, Daniel.
Yeah, I don't think that this interface allows the people in the webinar to speak directly to us, which is really a shame. I'm going to see if there's a way to do that. So feel free to put your questions in the chat. It's up there in the top right-hand corner, I believe. At this particular moment, we don't have any questions, which is definitely unusual. It might be people are getting used to the interface. But let me ask you, when you're talking about beyond the core four, oh, Prolette just threw a question in here. Can you speak? And I think I've done this by accident several times. I can actually put it on the screen.
Oh, there we go.
There we
Can you
go.
speak about what a typical deal looks like for an investment not in the core four versus in the core four? Yeah, that's it's an interesting way to frame it. I think the deal type or the deal structure is rarely going to be different, right? You're going to either invest in an equity position or you're going to invest in some sort of debt position, whether it be senior debt or it's going to be some sort of preferred equity or mezzanine debt as well. When we look at the types of underwriting that has to be done, it can be a little bit more in depth, right? If you're investing in a multifamily building, right? You've got, let's call it 12 units or 20 units. You can look at the rent in the market for similar units. You can look at the cap rates that are going. You can see what the maintenance cost is going to be, figure out your NOI. And I think that's a fairly understandable underwriting situation. When you're underwriting something like a hotel or you're underwriting something like self-storage, that's very, very different metrics that you use. You use something for hospitality, like a hotel, for the average daily rate, and you're looking at what the seasonality of that building is. So there's a bit more nuanced work that has to be done. And even for something like self-storage, even though it's similarly renting space and occupancy for the space, the different types of rents and looking at again what sort of units are going to be used in the area is very, very different. But this actual deal structure is exactly the same for the most part. When you're working in the middle market and you're working with syndicated investments, as many of you probably have done, the terms between the investors and the sponsor, the investors and the syndicator, are always going to be bespoke to each deal. But the types of returns are fairly in line with the rest. You just have access to a much more evolving set of deals, a much more evolving set of investment opportunities that you can get access to.
I wanted to ask you, what asset classes are you particularly bullish about in 2025 when you look at things that are outside the core four? Campgrounds, hotels, medical offices, self-storage, car wash, and student housing is what you had in your slides. Is there an area of focus for equity multiple?
Yeah, I think this also goes along with William here, who asks where your property is located. So what are we looking for? What are we looking? Where are we looking? What are we looking for? And I'll start off. Equity multiple is fairly agnostic when it comes to what we're looking for and where we're looking. We look at all asset classes. We still do a large amount of business or transactions in the core four. We still look at almost any metro. There was a time where we really weren't seeing a lot of opportunity in places like New York and places like California and Miami. That's sort of turned on its head recently. And in the last 6 months or so, we've seen 3 different investments in New York, Manhattan specifically. And we've seen a lot of investments coming in for more, top tier metros. And a lot of that has to do with just the market dynamics. In terms of asset classes or property types that we're looking at, I think we're seeing a lot of value in self-storage. There's still this a lot of movement happening in the economy. And I think car washes are going to come back a lot more attractively as well. With the new administration coming in, we anticipate that the Tax Cuts and Jobs Act will be extended, or at least some provisions, and specifically those things that'll help out real estate investing. And with that it'll be a lot more focus on depreciation type assets, which I think car washes have provided significant amounts of depreciation in the first year for investors. So yeah, our CIO is seeing several car wash opportunities come down the pipe. We're just syndicating right now a self-storage investment that we saw had a really great opportunity in Texas. But even within that, even within the core four overall asset classes, we're seeing specific opportunities in specific types of industrial And really, we like mixed use, I think. Mixed use is very, very attractive. It's a mix of residential and retail on the bottom. And those mixed use buildings are fairly attractive because they have a little bit more stability, diversification within one package.
How do you deal with the asset management of so many different types of assets and particularly over such a large geography as well?
Yeah, yeah. We've got I think we're at 6 people on our asset management team right now. They cover a fair amount of assets, and they've got decades of experience combined between them, and they've worked on a lot of different types of assets. We don't Before we move into a new type of property, right? If we are going to try to move into something a little different than we've done in the past, it does take some setup time. But we've got a really broad real estate team that has specific experience doing a lot of these different types of assets. Marius is a whiz when it comes to car washes. He's done lots of different types of car washes. We've got Dan Milo, who's really good on the debt side. We've got Peter Palladino, who's done several hotels already. And on our asset management team, across the board, we like to assign the assets to people who are going to understand that asset really well and work with the sponsor to manage that asset and make sure that they're not doing improper things with our assets. But it's important, I think, for asset management team to have experience doing the asset. Now, across the geography, it is pretty far. We like to get out and see the assets as much as possible. But I think that's where building the trust of the sponsors is important, because we've worked with a lot of them before. We've done multiple deals with several of these sponsors. So we don't have to be hounding them. We don't have to be on their, down their neck every single day. We can check in with them weekly and maybe check in on the asset quarterly or so.
We have another question here from Prolette. She says, on your website, your investment minimums are 15K. It says 5K on the front page, by the way. This is often smaller than other sponsors. Can you talk about this?
Yeah. So first I'll address the more easy question, which is the 5 and 15. For new investors, we like to have a lower minimum. We recognize that it takes a lot of trust building, especially with certain syndicators going in different directions recently. So we want to reduce the amount of upfront capital it takes to learn about our platform and build confidence in it. And like I said before, diversification is probably king when it comes to investing. So being able to diversify $100,000 across 20 deals is a lot better than having to put all your money into one deal. For us, pushing minimums much lower has been one of my biggest drives in the last couple of years that I've been at Equity Multiple. A lot of sponsors want to deal with fewer LPs. I would like to spread the benefits of real estate to as many people as possible. We negotiate with a lot of sponsors. We have majority control on a lot of our equity investments, which allows us to price the minimums much lower. So we don't have to be capped at a certain number of investors. We can, take in as many LPs as we want into our investments, which allows us to reduce the minimums pretty low. I think a lot of sponsors, this is completely hypothetical, but I think it's directionally correct, is that a lot of sponsors want to give the appearance that their deals are as more exclusive than they are. And I think that it's important to keep your deals open to a lot of people. And I think the democratization of the asset class is incredibly important. Maybe I'm speaking a little bit too far, but I think that it's important to keep investments low, because investors want to have the ability to invest and diversify. And if you allow people to diversify, I think business-wise, it's just good for all of us that if you can diversify, you're going to probably do more business with me if you can invest in a lot of different types of deals.
A lot of operators often have their prices lower because it will drive up expenses on the fund side, the tax preparation, the accounting, all of that. How do you handle the scalability of your expenses with such
Yeah.
low minimums?
Yeah, we might have talked about this in our prep for this or in another one, but yeah, I think with us, we've engaged a lot of new technologies. We've got a really great tax preparation service, which keeps our costs down there. We've got good relationships with our accountants and lawyers to keep costs at a very manageable level. I think we generally, our costs per entity are just a few tens of thousands of dollars spread across 100 or more LPs, so it's fairly minimal. And it doesn't scale necessarily linearly with the number of LPs. When you're working at a smaller syndicator or a smaller shop that doesn't have the scale as we do, you probably run into some per capita issues where it does start to scale more linearly. Your variable costs outpace your fixed costs. But for us, our fixed costs, I think, per entity are much more manageable when it comes to the per capita cost.
All right. We have two similar questions here. I'm going to display Manju's question, but basically they're both asking about what are you seeing as typical returns, and there are three asset classes named: self-storage, car wash, and multifamily.
Yeah. In general, I'll talk in general terms. Our target for an equity investment across the board, we're trying to get over a 20 IRR. Now, I can't give specifics for assets available. We'd have to just do the offering requirements of our investments. I would have to verify accredited investor status, but we are targeting something over a 20% for most of our investments. Across the board, our track record, I think last I checked, was an average of a 17% IRR. However, that includes a blend of debt investments and equity investments. And our platform in general has been about a 60% debt allocation and a 40% equity allocation across the last 10 years that we've been in business. Now, when it comes to geographies for multi-tenant, Philip, what we have is still seeing some opportunities in Texas. We just had a really good multifamily development in Tech Ridge, and then we're also, like I was saying, those three that we saw in New York have become much more attractive recently because of the depressed prices and some rejiggering of institutional portfolios. For me, it's really attractive. I live here in New York. I'm out in Queens, but I go to the Manhattan a lot. And being able to see New York real estate available to smaller investors is great. So we're seeing a lot of opportunity here in Manhattan. It's a strong market. We're getting discount prices due to, as I said, institutional investors reallocating their portfolios. So they're selling at a loss, or selling their properties at a price that is probably lower than they should be, and we're picking up that value and being able to increase the rents, manage the property, and making the money on the trade. And then for Prolet here, favorite asset type at this time.
This is going to be similar to my question. I was going to say, what are you bullish about in 2025?
Yeah. I think still the car washes. In terms of preferred equity, we're seeing some good value in car washes. Just the pricing is really attractive there. My favorite asset class, it's not necessarily outside the core four, but the grocery anchored retail, I think, is very, very interesting. We've seen a lot. I think it gets misunderstood. Grocery anchored retail, or retail strip in general. People think, okay, retail, e-commerce, it's going to destroy the local J. Crew that I go to. No one's going to go there anymore. But there's a lot of essential businesses that you just can't do online, right? I can't go to the gym online. I can't get a coffee with my wife online. I can't go and browse a bookstore online. Like, yeah, you can buy things online. I can get coffee delivered to my house. I can do whatever that mirror thing is with the workout, but I don't like those things. There's a lot of people that don't like to go to the gym or work out by themselves. So when you think about essential retail and you think about essential strip centers, that's where I think you see a lot of value, because the mismatch between pricing of traditional retail cap rates overall is different. You've got to really bias your assessments in terms of what the essential nature of that retail is. So if it's being priced as just retail because the market doesn't think very specifically, but it's essential retail, it's a bit more stable and you're able to get better risk adjusted returns. It might be a 17, 18, 19% IRR, but it's a much lower dispersion of return outcomes that are potentially possible with something more essential type retail as well.
All right. Fang has another question here. Do you issue K1s or any type of statement? Also, do you send out communications on a monthly or quarterly basis?
Sure. Working in reverse, our asset management reports go out quarterly. We like to report about 45 days after the quarter end or earlier, depending on how quickly we can prepare the statements from the sponsor. But you'll get a quarterly statement a quarterly asset management update every 3 months. You can download a statement. Our portal is all online. Didn't really lean too much into talking about equity multiples as a platform. Want to keep it more educational. But maybe next at the end of this month, I think we're having another one. I can go a bit more into our platform as well. We issue K1s for our equity investments, preferred equity, and some of our debt investments. However, most of our debt investments and our Alpine notes are going to be a 1099. So simplifying the tax preparation, along with partnering with that technology firm for our tax preparation in general. They've been much quicker with our K1s as opposed to previous tax years. So we're getting those churned out much faster. And for some of our entities, like our Ascent Income Fund, we control a lot of the tax preparation. So we're sometimes able to get some of the K1s out before the regular tax filing deadline. But it is entity specific. It generally splits between debt is senior debt and mezzanine debt are going to be 1099. Preferred equity and equity are going to be a K1. You're muted there, Daniel.
All right. Does anybody else have any other questions? We don't have any more in the chat currently, but it sounds like there's a fair amount of interest here, particularly in just more about your platform. So I'm glad you're coming back in a couple of weeks. You'll be back on the 31st, I believe, Friday.
Yeah. Let's
see.
yeah.
William
24th,
McSeek has another one. 24th? I'm sorry. 24th.
It depends on the type, William. Yeah, and going off of Fang there as well. So what's the hold period and the payout? So the hold periods for some investments are going to be depending. So the equity investments are typically going to be a 3 to 5 year hold period. The debt investments we target anywhere between 12 to 24 months. Really depends. The debt and preferred equity, targeting 12 to 24, up to 36 months, we'll see. But we like to keep those a bit shorter for more bridge scenarios. And then the equity targeting, I know a lot of investors like to keep them around 36 months, 3 years. We'll go out to 5 years for something really, really good. But I think trying to keep in line with what investors are demanding, we like to keep them around 36 months as well. The payouts are going to depend on the investment. For our debt investments, they'll pay out typically monthly. So a monthly pay. For those, we're targeting around a 12% total interest rate. So net interest to investors, about 12% paid out monthly. And then for the equity investments, those are typically going to be quarterly, and they'll be paid just like any other equity investment if cash flow is available. So they have no fixed payment, no contractual payment for the equity. Depends on if there's cash flow available. Are the financials audited? It depends on the entity. I've got to check with our finance team. We just went through an SEC audit, so we are still working through all the financials there. But in general, we'll have to check all the entity specifics. We do take SDIRAs. We work with a broad array of platforms, most of the big ones. Alto, which we've worked with pretty extensively before, I think is the platform that most investors think is the best. It's the one that our ops team thinks is the best as well. So very easy to work with. That's not an ad for Alto. It's just what we believe.
I'm becoming a little spoiled here in that I could just put the questions on the screen, but let me read them out loud for everybody, especially if you're not seeing the video. Is it easy to move your invested money from asset to asset?
No, so generally these are going to be illiquid. So you invest and you tend to have your money locked in there for the hold period. For our Alpine notes, those are 3, 6, and 9 month maturity short-term notes that are backed by a portfolio of about 3 dozen different transactions. Those have the ability to move to other investments on the platform after a 30-day hold. And then our Ascent Income Fund has liquidity after 1 year. So after 12 months, there's options to redeem. You don't have to move it to another investment, but you are able to redeem the money from the fund there as well. So different types of liquidity. We're trying to bring more investments to the platform that have potentially more liquidity. But in general, as of now, most of the direct investments, those that are into a single investment or a single portfolio of properties, are going to be generally illiquid for the hold period.
All right. And I think that is all right now. I want to put out a standard disclaimer that the Alternative Investing Club doesn't recommend any funds. We're here to provide speakers a platform and to let them to educate us themselves. And so, Daniel, if that's all the questions, if there are any more, I'll take them right now. But if that's it, I will thank you for coming in. And one of my favorite things to do, have everybody take themselves off mute and thank the speaker for coming in. I don't think we can do on this platform. That's a shame. That was always wonderful. Well, anyway, if you want to thank the speaker, go ahead and put it in the chat.
And if anyone needs anything, I'll be back in the next couple of weeks here. We'll be talking, a couple of deals that we might have available. And if you ever need anything, you can reach out to us at ir@equitymultiple.com. My inbox is more than willing to answer your questions. So please reach out to us.
Thank you very much. And we'll see everybody next week at 12 noon for the Alternative Investing Club Friday live meeting. Cheers.
Thanks, everyone.